It's my privilege to introduce the panel to you. Mr. Raveendranath Kamath, as you all would be knowing, he is the president of Kerala Angel Network. He is a part of almost all the startup ecosystem initiatives that happens here in Kerala. And apart from all the other activities that he does, he is also the co-founder and the CFO of Next Education India. And we have Jacob Mathew, co-founder and MD of Mape Advisory Group. He's a seasoned investment banker, and if you visit his Bangalore office, you can see a wall of fame filled with tombstones of closed transactions, including Mahindra, Tata Group, you name it. We also have Mr. Deepak Mohan, director of Mape Advisory Group. Deepak has over 12 years of experience across industry in investment banking. He has closed various PE and M&A deals. Deepak has also worked with Avendus Capital, KPMG, Coca-Cola, and the Bangalore Stock Exchange prior to Mape Advisory Group. Over to you, sir.
Good afternoon, everybody. Happy to be here, sort of back home for me. I have, I guess nowadays it's the age of youth. I have two youngsters on either side of me. They are obviously much better equipped to talk and also just happens to be much better dressed for the occasion. Kamath is an old friend. I know him for 18, 20 years. But he has angel investing in his blood. So maybe I will ask him to make some opening remarks about, what does it mean for an exit? Why does a company needs an exit? Somebody will ask either, I mean, why? What is the need for an exit? Because you have taken money from outsiders and there is an inherent promise. But let me ask him to explain that in his own words.
Okay, so before we start, I would basically like to understand, are you mostly startup founders? Anybody who is not a startup founder? I guess, yeah, okay. So all of you understand what is exit? Okay. Is there any specific, okay, so just to take a few seconds here, right? So we can have a Q&A session. So we would like the experience of, we would like to, leverage experience of Jacob and Deepak here, who have probably 100 times more knowledge on the subject, because they have done deals for the last 20, 30 years. So definitely we would, you should use this opportunity to ask if you have any specific questions in the session or afterwards if you can catch them. Probably 1 hour, 15 minutes. So we would definitely want to have more Q&A towards the end. So please keep your questions ready and probably, if possible, pass it on. So back to Jacob's question, right? So as a startup founder, do I want an exit is probably your individual question. I think there is definitely a need or a justified need to have some financial returns, because most of the founders, as you will be completely squeezed. So you will be working, yesterday we were talking about this, right? So you're working probably 12-hour or 70-hour weeks or even more than that. But so and most likely you are under high stress all the time, and not likely that you'll be able to spend time for your family. So I think at some point, some financial reward is required also to pay off your loans and other things that you have, and probably have a more comfortable life, which will let you help run the company better. In that context, I would say, once you have established or stabilized your business, I think you should definitely try to get some money for yourself in one of the rounds, or maybe Series B or C, or whichever way you like to look at it, right? Especially if the company is not making immediate cash and you are able to pay dividends and have high salaries and all that. So that is my view on the exit.
Let me just add. Can you remain without an exit? Okay, let's start with that question. Lots of Indian family-run businesses have remained without exits, right? Then you have a different set of issues in life, succession planning, can you professionalize? A great example today is, Zerodha, which is, says that they will never be a public company, right? There are investors there, they will be given exit. How will they be given exit? They will raise money, they will leverage it, they buy out the rest of the guys, and the family is happy to do it. So today, as of today's view, Zerodha says, I will not go public, there is no exit there. But that will probably work for 1% or 5% of the companies. For everybody else, maybe, and if you've raised money, then there is an exit required because the investor's alignment of time horizon is not the same as yours as a founder. Okay? So if we take no exit or remain private within a small group of people, run a nice lifestyle business, no exit required. If you don't fall in any of these buckets, then you need an exit. And if that is the primary perspective with which you start working, then what are the possible paths to exit? One is get acquired by somebody. A smaller path for companies is go public. These are the two options left, right, on the table. Now, with this, two things, if you were to tick off, and so then the rest of all the strategies, whatever we will talk for the next maybe 1 hour, is which of these two paths and where do you go? And how do you end up on each of these paths is probably the discussion that you will probably end up having to think. Do you need an exit? Is a decision which is not just yours, it is your investors, your employees, because family, we keep saying, it's not just the founder, but it's his family also is a part of the company, right? And India, we've seen, people across the globe. Indians have a bad habit of letting personal and professional balance sheets get intertwined. Your finances are intertwined. They never separate. The stress that you get from the emotional baggage, the stress of your company extends to your family, and the financial stress of the company or the well-being kind of then, gets into. Because I was having this conversation with a friend of mine. I said, "How are you?" He says, "We are doing well." I said, "Who is we?" He says, "Me and my company." So for a lot of them, like with Jacob, I can say, I worked with him for, he has 3 kids. First is the company and then 2 kids, right? So it becomes very personal, as a founder. So it's better, it's the right thing to do for your family to ensure that you've de-risked it and taken some money off the table. How much, what quantity, when, all of that is a separate question. But family is a critical thing. Employees, early stage employees who came with you, believed in your vision, they probably need a payoff. Investors are another bunch into this thing. So that's probably the larger, if we were to start off with that canvas, yes, exit, then there are 2 paths, and then I think we can probably go down that path.
Maybe, Kamath, I want to take on something which Deepak just mentioned. I guess there are some few entrepreneurs, startups and otherwise sitting here. Invariably entrepreneurship is always much, much more difficult than a job. Your job normally ends 9 to 5 or 6 or 7 or 8. You don't really carry the stress. As an entrepreneurship, I've been an investor, but I also been an entrepreneur. I started a business, ran it for 20 years. With God's grace, I managed to sell it. in an industry where theoretically exit is not possible because, it's a people's business. I've been lucky. But entrepreneurship is invariably you carry the stress back home, and then, I keep asking everybody, what is the end story? I mean, all of us love to think that, we are immortal, we will work till 70, 80, 90, whatever, but for God's sake, if something happens to you, what happens to the business? And running a business and an entrepreneur, especially in an Indian context, is many times like sitting on a tiger. The day you stop working, the day you get off the tiger will eat you. As simple as that. There is, I think Deepak mentioned in passing, we have this, if you are running a business as a lifestyle, this is better than working for me, for somebody else. It takes care of my monthly expenses, maybe a little bit. Great. Nothing wrong in it. I mean, it is not that a business has to be, an entrepreneurship has to be done IPO or have to do an M&A sale, etc. Finally, all boils down to what works for you. What do you want? And please, when you ask you that question, be truthful to yourself. The most dangerous lies are the lies we tell ourselves, not to our investors. If you are saying that you are enjoying the work and we are not, you're going to have some serious problem. Look, I have been on both sides as an entrepreneur, as an investor. Some bit of exaggeration and lying is the investors also expect.
The joke we have is, every Booker's list, whenever it comes out, we look out for bankers and entrepreneurs because the stories are being told there. The fiction is written there, not so much in the non-fiction category, right? So don't believe the Kool-Aid that you're giving others. Be truthful to yourself if you're trying to decide on an exit. Because that is then the first step that you should be taking. If the business is not going to be, what's the size for a good IPO today? 500-600 crores. Of course, there is an SME board, all of that stuff. Old timers like us, we've seen these cycles. Long ago, there used to be something called the OTCI exchange in India. Okay? Came in, died, went away. Now we see a new avatar in SMB. So, of course, today somebody will tell you a 60 crore company can go public. You can't sustain it. Take it from me, quarter on quarter, compliance burden, all of that stuff. A listed company stock is not something you can live by. Okay, India is an immature market. Every time you sell 2% of your stock, you will get hammered in the market because people will say, oh, the promoter does not believe in the story of the company. We are not a market where, like the US, you can say, listen, I have a professional management team. I have other needs in life. So these are all, so if you can't be a 700-800 crore company and do a proper IPO, then the only route that is left for you is selling out to somebody. And if you're not on those paths, then get to the stage where you're saying, yes, I'm doing this for a lifestyle. Don't take external money. Don't use ESOPs as currency for your employees. Keep it that way. Keep life simple. Keep it uncomplicated. Then things are fine. If all of these get ticked, that is when you should start using ESOPs as currency. That is when you should start getting external money. And that is when you start the journey of saying, yes, now this is a business I'm building for exit. Because the path to exit gets starting, the degrees of freedom that you have on that go away from the day you get your first investor. You get a family HNI, the path is different. You get an institutional venture fund, the path is different. You get, somebody who's, let's say a corporate venture fund. If you're a fintech and get Visa tomorrow as an investor, the path becomes different. So the first step towards your ultimate exit is probably taken 10 years ago when you got your first investor. You can't change too many of those things. It starts getting cast today. Okay? So be very careful as to the first step. You can say, oh, I don't know. Great. Nobody knows what will come out of it. But steps that you're taking every single time is reducing the degrees of freedom that you have for the ultimate decision that you might have. Some people are lucky, you get, rising tide, you end up making, you get great options to exit. But that happens once every few years, But mostly seen across cycles, this is going to be a tough path. So decide every single step that you're taking. If an exit is required, be careful, because everything you do impacts the final go, no go on the exit and the valuation.
So if I may just add to it more, again, a number perspective, if I may add, correct me if I'm wrong. So let me put myself in their shoes, and let us say I have an investor on board. So what is the kind of return you should see? You as an investor should be given exit prior to probably I as a founder is eligible to ask for. Maybe a small portion we should, I think, agree. But so as an investor, what kind of returns are we expecting? What I think mostly, some of them might already know. I think we should probably talk about what is the return expectation of an investor, and then combine it with is an exit possible along with an investor exit? What has been your kind of numbers?
I guess lots of people have, when I say investors, when you are taking money from an angel investors, it finally boils down to individuals. So people have differing these things. But in general, if I have to use theory, equity means people expect around 25% return. That is the sort of starting point. And 25% return means roughly money, not roughly, money exactly doubles in 3 years. That is, so your valuation has to double in 3 years. If you are holding it for 6 years, it has to become 4 times or whatever. But having said that, not all investments make 25% return. I wouldn't ask Kamath as to what money he made, but his earlier avatar, when he was working with a friend of his, who was also actually a friend of mine, Anurag, what's his full name? Anurag Dikshit, one of India's not so well-known stories. He's an IIT engineer. I think you're probably classmates also.
No, 4 years senior.
He's senior to Kamath, but he was a jobless software engineer in US. He came across a lady, a Jewish lady, who was trying to set up a online poker site. She didn't have money to get a software person, so she gave him 50% of the company to write the code. That company went and listed at $8 or $9 billion valuation, and Anurag, 15 years back, was the richest liquid Indian. He was sitting on some $1.2 billion. I remember I knew him quite well. I knew him when his company was worth $5 million. So after he became rich and whatever, I remember introducing him to, at that time, Dr. Anji Reddy, who was India's largest philanthropist, etc., etc. So Anji was talking about, I put 60 crore, I have done some livelihood, etc., etc. So half an hour, 1 hour over the lunch he took. End of it, Anurag sort of said, yeah, sir, I just donated some 100 million pounds to Imperial College of Medicine or something like that. So, people have exited and made some serious money. So whoever put money with Anurag, I never asked, made some serious money, not only the investors, but also employees. Their option
Like
sort of.
Like me.
I wouldn't ask what stake Kamath had, but that company was worth some $8-9 million 15 years back, am I right? And in a span of 10 years went up from 0 to
Actually, that's a very...
I'll just add one interesting report which came out yesterday. Okay, if those of you who track this space, and Bloom Ventures is probably amongst the better known early stage investors in India, right? They've come out with this report called on their first fund, 50% of it was write off. Okay, 0. They wrote it off. That's how bad or good the success rate is of a very successful venture firm in India. Okay. The returns seem to be, as of now, about 14-15% is the IRR. They expect it to go to about 17-18% for themselves as investors. And why is India such a tough place to, take off on what Jacob said? Indian public markets have typically returned about 15-16%. So you go to an hello, yeah. He'll say, I can put it in a mutual fund, have absolutely no headache or heartburn of having invested in a startup, the emotional upheaval that it brings up with it, and still make 16-17%, if I were to do it. The typical cost of capital in India is about 17-18%, right? Mid-cap funds have returned about 21-22% in the last 15 years. So you're competing with that. So if I am an investor who's investing in this, and that's where they start. And they're looking at each investment and saying, can I reach that? Can I get that kind of a return? And that's the question that you will get. Now, whether all of them will turn out to give you, 2x over 3 years, all of that stuff is a different thing. But that is the starting point of evaluation for most seasoned investors who end up doing private investments for you. He has in his control is the multiples that he's giving you on day one. So if these are the 3 parameters he's running in his head, and the only 2 things that are in your control are probably market to some extent if you're a startup guy, not so much because of the competitive intensity. And, the bottom line is, of course, what is under your control.
I want to do this small exercise with you. You will need your phones. No, not with you. I mean, with the. You will need your calculator on the phone, unless you are Shakuntala Devi and do the math on your own. Maybe you know this already, but I think it's. I'm sure 50% of you won't, and it's probably the one small value add you can make. So I would like you to tell me, if I invested 100 rupees on, say, year 0 and got, let's say, a return of 500 rupees in year 3. So end of year 3, in 3 years, I make 500 rupees. So I invest 100 rupees, got back 500 rupees.
At the end of 36 months.
At the end of 36 months. Question is, what is my IRR? IRR is internal rate of return. Do you want me to repeat the question? I would like you to try.
And whoever has an answer, if...
No.
Please raise your hands and happy to.
Let everybody take a dig at it. I'm sure you know how to use Excel, calculator, anything. You can use any...
Question is simple. 100 rupees invested today has given you back... Sorry? Given you back 500 rupees at the end of 36 months. What is the IRR, the compound interest rate, if I were to translate it into? Huh? No?
Okay, so you want to explain how to do that on a calculator? No.
You are...
You are not eligible. Good. Okay. You did a Google. Yes. Okay, that's smart. Yeah. Okay. Any mechanism. Yeah. Something like that. Yeah. 3. 3 years.
3. Cube root.
Okay. So on Excel, this trick I think you should learn. Or on a calculator, if you flip it, you will get a scientific calculator, right? So on scientific calculator, you do this 5 divided by 1. So you have a 5, which is your value. So, and you would see a x power y anywhere. So 5 divided by 1 by 3. 5 power 0.3 or 1 by 3. 5 power in brackets 1 by 3. Whatever that is. So it will look like 5 and a caret symbol. I don't know how to show you guys. So you will get a number which is 1.709. So
71% is.
71%.
71% is the return.
Okay,
right?
so now the corollary to it. I hope you get it. If you don't get it, please understand, because when you talk about exits, the other side is going to talk IRR, and if you can't do this basic math, I think it's a tough scene. So you should, this basic skills, right? When you talk about, and the reverse is you do if the investors here say that they want a 25% IRR, and you have been invested for, let's say, 7 years. How much should 1 rupee return? Can you do that? So the question is...
Question is, as let's say 100 rupees invested today, my expectation as an investor is 25% return every year. And the question is, if say we are running it for 7 years, what is the end game at the end of 7th year? How much should 100 rupee become at the end of 7 years to give me a 25% return?
Use your calculator. There is no shame. Try it. I mean, there should be some reason it's called, yeah? How much? 4.7. So you should get something like 4.7. So, and sorry.
Yeah, 4.7 times. 100 rupees should become 476
So
rupees.
whenever you think of raising money, please think 25 and then do this 1.25 power whatever.
See, that's the expectation. So, so now if we were to come back to say, okay, if this is the end goal that we are trying, how do you get there? Or should you, and at what timing, right? The market is what is going to give you the multiples. Your competitors might be raising money at, it's just craziness happens, like what we saw maybe 2 years ago. Everybody and his uncle has forgotten the value of money because it's cheap. They're getting it. Maybe if you're not even ready for the exit yet, but you're still getting it, you should take it. Okay? Because these things go in cycles. There's cost of money which is running around. And today the same companies probably are not worth what they were 2 years ago. Because remember, the clock is ticking. So, this might sound like not a very cheerful session, okay? But this is the reality. When you're talking to investors, when you're getting somebody to invest the money, this is what you're up against. It's not just the business. The investor is sitting there. He's having this expectation. This is the clock that he's ticking on. So if you're not on the same page, don't start. Don't take that money. Build it in a different manner. Okay? So that's the first, I would say, takeaway from this. The second is, the second thing is probably, if you've given away larger stakes very early. Yesterday we were hearing about one of the companies, they said for about 40 lakh rupees, because it was very early, they gave away about 20% stake. You started on the wrong note. You've raised it too early, because then that guy is probably, after multiple rounds, you as the founder, you're probably, and if you have multiple co-founders, you're down to about 10%. If the kitty is 100 rupees, you've worked all that, you're going to look at it and say, did I work so hard for 7 years to take 10 rupees out of the 100 that I created? Why did that happen? It happened because you gave away 30% on day one for very small sum of money. So one of the things that you'll hear stories about, in Ola, this guy has only 5%, in Byju's, maybe the founder has 10%, all of that stuff. But that is a different game where people are playing for $1 billion, size of pie and things like that. Those are one-offs. Okay? 95% of companies will not reach of that size, or maybe 99%. You will all end up in maybe 100 millions, maybe
100 crores.
100 crores. 100 million is a
Nothing
large.
wrong with 100 crores.
Nothing wrong with 100 crores, by the way. Yeah. So if that is the kitty, then if you are going to reach that end point of the journey with only 12%, 15%, or within the co-founder pool, say 30%, then you are going to take home 10 crores. If your salaries these days are not as bad as it was, say, 20 years ago, if you are a well-paid professional, you'll probably take home about 1.5 crores. Okay? And so after putting in the hours, after the hard burn of running a startup and taking everybody along, if the upside is only say 50%, is it worth it? Then what are the parameters you played with? The stake that you were holding, or held at on day one and then holding at the end of the journey. How much did you raise at each of those days? And see, capital has a cost. Nothing is free. It might look like free money at this thing, but the clock, as I say, it keeps ticking. So don't get set on that journey without having these things in mind. Your entry and exit stake that you're holding as a founder is the key, because that pool is getting split in that many forms.
I have heard equity is, very few people will tell you this straight on your face, is the costliest financing option you can ever get. People think that, it is not debt, it is equity, I gave him only 10% stake, 20% stake. You have given him 10% of your life for the next, what are you going to do with your life for the next 5 or 10 years? Equity is the costliest way of funding. If the business is strong enough to get debt, I would any day ask you to get debt. And equity also means, lots of people I know that look, somebody invested, so money was easily available. Because of that, I started a startup. For God's sake, don't do this. Don't do this to yourself. It's like a calling card. I have a startup of my own. That's not going to last unless you are willing to give a fair amount of your personal life. And an entrepreneur's journey any day far painful than
It shouldn't be so depressing.
Huh?
So
it is much more exciting, much more interesting. It is adventurous. It is passionate. But you are going to pay a personal price somewhere for it.
So make it worth it.
Huh?
So make it worth it.
Make it worth it at what cost?
For yourself. We say, we have this thing. The only reason why you land up with all enthusiasm on a Monday morning to office is either you have high debt or high equity. Okay, most others just come to office to go back home at 5 o'clock. Okay, so be careful as to why you're landing up in office on a Monday morning. Okay, it's a bit better be high equity because you're then working for yourself. At some point, it's okay to work for the bank, but otherwise, why go through all that? And remember,
But when you say that, right? So on the other side, the flip side is, debt has other angles. So
I'm with you. See, okay. But remember, people who write equity checks can be equally mad. Okay, a debt financier is slightly saner as an animal, I think. So you can't get unlimited debt. Sometimes you get unlimited equity and you lose your company.
Only slightly.
Only slightly. These are, these madnesses go in cycles. There will be times when money will be available like crazy. We've seen people write, come to offices and say, here is a project report. My expectation is I need 2 crores at 60 crore valuation. And we'll be like, okay, thank you. But let's see it when you actually have a business model in place. But then he'll go to the next door and he'll find an investor for it. Okay, those times happen, and then you'll end up in funding winters supposedly, which is what is running today, where even good, sane business plans don't get money. Right? Those cycles keep going on. So your fundraise cycle and your exit cycle, if the end goal is for an acquirer to acquire your company, remember he is also going through his own cycle. He has his business needs. He needs to acquire you to meet some corporate goal. There might not be any acquirers in the market. Like, we've seen cycles where there's this very famous company called TiEcon in the US. At one point of time in the past, they were acquiring 3 companies a day. Okay, 3 companies a day is what they were acquiring. GE used to acquire about a company a fortnight. Okay, craziness happens. Okay, and then TiEcon then flipped over and was shedding a company every week. So they at one point of time had 475 divisions and companies, and then they sold a company every week. So these madnesses happen. So if your goal is, you're, let's say, a SaaS company, and you're saying, listen, at some point of time, one of the larger aggregators who wants to have multiple SaaS offerings will come and acquire, he's doing a make versus buy decision in his mind. He's thinking, can I just hire your own, large part of the team and get the same offering in? He's thinking very differently as well. So if you have a certain acquirer in mind, or if you think that this is the guy who's going to give me and my investor and my employees the exit, please spend some time when you start getting close to your exit, thinking about why he should be acquiring, what are his motivations to acquire you, and are you like good enough to kind of get picked up and go to the end with him. Because remember, not too many acquirers exist. The classical element, the famous McKinsey study keeps, I've never seen that study in my life after being a banker for 20 years. The true story where they say 70% of M&As fail. Accenture has a very famous study which keeps getting quoted saying 55% of all M&As fail. So the bar is getting higher and higher for a corporate acquirer to acquire you, okay? Because nobody knows how to make it work. So these are constraints that you're working with when you're looking for exits for yourself.
So just to add to that, so interesting stat also is that for every IPO, probably there are 20 or 30 M&As that happen. So the path still remains, mostly on M&A than IPO. I think IPO's option is probably far more remote than you getting acquired. So just time check. So we have 15 more minutes before we have Q&A. I think it is going to be worthwhile discussing some options. So as a startup founder, you will be entering into some sort of a shareholder agreement, share subscription SHA agreements, right? So do you think it will be helpful for you if we discuss some of the key parameters? There are a lot of key clauses which work on exit. Do you think it will be helpful? Or we can talk about other things?
We can just ask for.
We can ask, we can just see what, just sort of maybe
people have. And
what people have in mind. No, maybe, if you can ask some questions and we'll take all the questions together. We just want to have a feel of what are the things sort of top of your mind.
If we've missed out something very large, you guys came in today saying, I'm going to learn about A, and so we've completely sidetracked it. We want to touch it.
Keep your hand up. I will make sure a mic reaches you. Any questions, anything to do with startups? While we wait for the questions, one of the things, I think Deepak or Kamath mentioned in passing about kind of investor, especially if you are a real startup angel investor. In general, don't take money from people you know personally. India people don't, the average investor says, I'm an angel investor, equity, etc., etc. An average person doesn't make a distinction between debt and equity. If for God forbid, for whatever reasons your venture fails and nothing is given, I've seen people, avan ende na cash medichondu poi onnum thannilla avan ippuram car odichondu nadakkunnu. I mean, he expects you to sell you a house or car and give it back to him, forgetting that it's equity he invested, not debt. And the average Indian individual also has a issue that if the investment does well, oh, you know, I have a Midas touch. Whatever I do well. You know, it's my destiny or end of the. If the money doesn't come back, oh, you screwed it. You know, you are whatever. Why are you still driving a car, etc., etc.
So I have a question for you on this. So this is something which came up. So what is the difference between a money lender and an angel investor?
Angel investor speaks in English, I guess.
No. Both of them have the same return expectation, right? 25% is not a small expectation, and that is the expectation on collectively pooled investment. So we would expect more towards maybe a 40% IRR on individual investment, because half are going to fail, so that have to cover up. So expectation is same as money lender. So then what is the difference? He already gave you the answer, but yeah, so probably answer is empathy. All right. So back to this question before your questions, right? So on the SHA, you would typically have a couple of parameters, right? Couple of clauses. One is liquidation preference. So how many of you have signed an SHA with a liquidation preference? Or have you heard of this term, liquidation preference? Okay, so
maybe you can explain what liquidation preference means.
Okay. So let us say I'm a founder. I have raised 20 rupees from him. Okay, let's make it more interesting. $20 million from him. Right?
Oh my Gishakar.
So I've raised $20 million from him at a valuation of $80 million. Right? We need to think big, right? So he owns 20% of the company, and he has invested $20 million. So I immediately raise the money, and the next day I decide to liquidate the company. So what happens when you liquidate? So no, so I didn't. So he short my question, but so if I don't have a liquidation preference, I can shut the company next day theoretically, and take away 16 million.
80% of the company.
Because I own 80% of the company, right? I own 80% of the shares, so I own 80% of the company. So I take the asset as the $20 million cash in the bank. I take 16 million. I give him back 4 million. He books 16 million loss, and we move on. Nothing wrong with it. So that's how it is, right? So technically, so liquidation preference says, no, sorry, you can't do that.
Rahul Yadav of housing has probably done it, so, but anyway, let's not take names.
Look, taking money from outsiders and running away with it, I am told, is supposedly the world's second oldest profession. So we should not hold grudges against people for that. That's been there, like there are scamsters who will take money from investors and running away with it. The investors are, while they call themselves, or we call ourselves angel investors, we are not angels by any stretch of imagination. We are here only to make money. It's greed. I used to work in a large American investment bank, Merrill Lynch. The joke was, in the morning the door opens because of greed. It's not to promote entrepreneurship or promote.
We add the third parameter. So you have go in the Monday morning. So you have either large equity, debt, or greed. Yeah? Sorry.
The investor has the first call on the greed. Remember. Any questions, please? Okay, you are going on the.
So liquidation preference basically says, if in the case of a liquidation or an exit, the investor's money has to be returned first, right? And typically it comes with, then there are variations of it, which probably you can read up more about it. You should also talk about, probably a couple of things. I don't know if it's relevant, does the drag right be discussed?
So just remember, you'll see an animal called a drag right. An investor says, see, an investor's alignment of interest is not the same as you, and his timeline is not the same as you. Please remember this. He's not your friend. Okay? So it might so happen that he's had great exits in his other parts of the portfolio, so doesn't need that money today. Or maybe vice versa. You are the best performing fund, best performing company in his portfolio and can be the only one which can be sold today. Okay? So both things happen. So you might not be ready for an exit, you will get dragged. And that is what the clause says. He says, listen, you told me in 4 years you'll give me an exit. I'm at the 4th year. Companies, you might say, listen, I've done all the legwork. There's this large contract coming in. There's this significant win. It will fundamentally change, how we are doing business. It will change my life. He'll say, sorry, I have my need. And because it allows you to drag, your lawyers will build in, language around saying, some safeguards will be there. But once those low bridge safeguards are met, he can force you to sell. Okay? It gets ugly. When we started our career, Indian court system used to take forever, arbitration clauses were meaningless. They're all getting enforced today. So you will get dragged, kicking, crying, you will lose your company. So be careful about some of these things. A good lawyer is a must. Please get them. Don't get into these documents thinking, let me sign it, I'll get to it later. Because the rights that you see keep increasing. Every guy who puts in more money comes to the front of the line in the liquidation preference. Last in, first out is the way it works. They have 1x, 1.5x participating, all of these things. So they will take their money first. You would have done all the hard work. You might probably get, 2 rupees out of the 100. So be careful. These are important clauses. They will get enforced when they have to get enforced.
Having said, nobody wants liquidation. No investor wants to go through that liquidation process, but it is more of a safeguard, but you have to be aware of it, right? And probably one of the conditions. So probably another thing which you should look at is convertible instruments. So I think you see a lot of safe convertible notes. Convertible notes are still not so common in the Indian context, but also just be wary of or worried about or concerned about the clauses that you will have when you have, because all of these, when you think about exit or the next round of investment, all of these clauses you should be worried about. See, if you're not able to raise without those conditions or clauses, it's fine. So you're accepting it consciously, that's okay. But if you're not, you're signing on something because you're in the midst of or urgent need of raising money, and then you sign these things up, then it's trouble. Doing it consciously, fine. Being aware of it, fine. Right? Because some of these conditions are unavoidable, right? It's like there's a note saying, there was somebody said, I had to pledge my house to pay the salaries, right? That is life in India. So no business in India happens without, or no loans in India happens without personal guarantees. That's life, right? So these are the realities of business. So probably one more thing if you may want to talk about, right? As a LBO, MBO, is that relevant in the Indian context?
Probably not relevant from a startup point of view. This is, basically LBO is a bit of an English, but to say in plain simple English, it is using the company's own cash flow to buy the company. You basically take on debt on the company which you are buying to pay off the person who sold the business. That normally happens in established companies with strong cash flows. One of the other things somebody was asking me is, as a startup, all of you say that IPO is nowadays open or available only for large companies. How can I sell my baby? Please don't consider your business as a baby. To start with, you should have a natural biological baby. Please have that. You may love your business more than your baby. That's separate this thing. But don't be caught in your own ego trip. I mean, I was working for first 15 years in my life as an employee. 10 years, I quit, started a business, ran it for 20 years. I sold it recently, but as part of the sale, I agreed to work for the new owner for 5 years. And everybody sort of turned around and asked me, Jacob, how did you do that? How can you sort of go back to an employee report to somebody? It's the best time of my life. I'm having a ball of a time. I have no stress of where my next month's payroll funding is going to come from. I used to run a high-end consulting business. I had my monthly paycheck. I had a huge, costly employees like this gentleman sitting on my left was about 1.5 crores. I don't have any revenue for a few months. I start sweating. Whereas I can't suddenly shut it off. Suddenly I am relieved of it and I am back to my elements. Lots of clients, I tell people that, boss, I have retired, I am not looking to make money, I am not looking to make fees, but I still do it because it's a passion. People react to me differently. So, there is nothing wrong in working for somebody after you are an entrepreneur. These are not... It's an entrepreneurship is a state of mind. You can be an entrepreneur while working as an employee. At times I've seen people say that, I am looking for recruit somebody with an entrepreneurial mindset. Somebody who stands up and says, boss, I will do it. I take responsibility. That's what, there is... Somebody asked me that, what's the definition of an entrepreneur? I have a simple definition. It's the person who stands up and says, boss, it stops with me. I am not writing a long mail to somebody else explaining why it didn't happen or these are the 5 excuses or whatever. I can't, I don't need to, I may have to explain to my investors, but the line stops with me. There is nobody behind. I can't go to my boss and say that my so-and-so colleague didn't work. What the hell? Why didn't you kick his backside and make him work? That's the way I would look at it.
I think we should open up for questions.
Briefly.
Myself said it. Basically, I'm product manager by profession.
Check.
Yeah. So myself, Seren, basically I'm a product manager by profession. So last 1 year are the other touch points I can explore. Second point is, let's say if I am trying to explore these companies, what are the parameters to keep in mind to invest in a company? Apart from the basic things like looking at a good, if the founder is good, or let's say the basic fundamentals are right, were there any key insights in your investing journey? Would love to hear.
The Kerala Angel Network most welcome if you join. You can start angel investing for as low as 5 or 10 lakhs. But having said that, let me caution you. This angel investment is what's called an alternate form of investment. At the age and net worth or whatever your other financial position in your life, it's probably too riskier venture. We have this joke that you should invest only that much. We as a company invested in some 15, 16 startups. We had this joke that, I should invest only so much that if for whatever reason the company doesn't do well and I have to write it off, I should be able to have a stiff drink that night and talk endearments about that entrepreneur's mother and sister and forget about him for the rest of my life. You know, मेरा पैसा भाग कर लेकर भाग गया, whatever.
If you wake up the next day thinking about that investment, angel investment is not for you.
It's
So
not your
expect to
destiny.
lose like 95% of the money, something like that.
100%. Start with that, and
Yeah.
once you've got your first successful exit, you should move that back to 95.
Got it.
Assume you're going to lose, okay?
Yeah.
Because there are just too many variables going on, not in your control, not in the founder's control.
Understood.
It's why you doing it, because it just gives you the thrill, right? Beyond a point, think of it as social service.
Got it.
Anything else is bonus.
So, okay, those of you, so there is something called as, you all know SEBI, right? So SEBI typically has criteria for angel investing. So I think it's about 25 lakhs is the investment that you should do if you're a fund. But the general concept is, I think, about 1 crore net worth and
There's an
apart from
accredited
your-
investor concept I think they've brought in, which is roughly saying, your net worth should be about 1 crore, 2 crores. They keep moving that number around, other than your primary house. So don't count that. And yes, and post that, the understanding is that you will invest about 5 lakhs. But all of these are,
If you have only 5 lakhs to spare, and if your risk appetite is that you don't mind losing everything of that, and you won't brood about it the next day. I said, I will talk endearments about his mother and sister, but I won't waste my time to call him up and talk those endearments. I'm somewhere, you should be able to whatever. And the second part of your question about what do you look for? While we didn't run a fund. We had a full-time day jobs. We were doing it on the side. So we just used to go by, theek lag raha hai, whatever, more by gut feel. But that is absolutely not the way to invest. I would rather deflect the question to Kamath, who's been doing it, and we do it as a process. Our thing worked for us because we're probably lucky. We're too damn lucky.
remember, if you are an investor, right? If the question is, should I be doing investments of my own? Startup investment should be the last step, okay? You need to have developed your own mental heuristics of how you are looking at different investments, gone through starting from mutual funds to individual companies, large companies to small cap, micro caps, in the listed, because there's no validation in startup investments, okay? Here you can wake up tomorrow morning and see what the stock market, 500 other investors are valuing that company for. In startup investments, it's your own vision and tunnel vision and what the founder is telling you as to what the valuation is. There's no market there, okay? You could believe that the company is worth 100 crores and there might be 0 buyers for that at even 10 crores, okay? So it's a very lonely, it's interesting. You'll meet fantastic people, hundreds of ideas. You'll say, oh my God, this is such a great thought, but not maybe 1 out of 100 might be investable and 1 out of those 20 might make money. Sorry, please. Yeah, okay. Other questions?
Hi. My name is Salman Faris. I'm from Calicut. So I'm asking about, you guys are talking about the exit strategy. I'm asking about entry. So basically, what are you looking for the investment as an investor? So I'm asking the people, the founders' value or ideation or energy or the ROI or the mains idea. What are you looking for exactly as an investor?
Can we, it's not in the...
As an investor, what you're looking for, ROI based investment is looking for the ROI or based on idea or based on energy of a founder.
I think it's a mix of everything. ROI is just a simple mathematical measure to which would some level encapsulate police smartano, decentano, kallanano.
Yes.
I mean, all those other things which you said, it's a mix of everything. Avilana. I mean,
Okay.
you can't say that, chene karna madarang. I mean, avilana ruji kittiyada ennu parayan pattiyada. I mean, it's a mix of everything. But I would go back to what Kamath was saying, that it's an out of syllabus question. I can talk about for a few days as to what are the things which we look for. I don't think you will still be better off. But having said that, happy to take this question offline. We are both, all of us are here for the next year.
Okay,
So,
thank you.
Is it different for each types of investment? Like I'm looking at in terms of angels. Is it different for angels? Is it different for VCs, or is it the same throughout? Or is it based on the stages where the investor comes at it?
conventional wisdom for any equity investment
In India.
in India. But having said that, angel investment is far more risky, so people probably expect, I don't know, 40-50%. 40%. He is talking about this famed investor called Kanwal Riki, who is part of TiE, but who says 40%.
See, basically the way you should think is, the earlier I come in, my return expectations are higher because it's supposedly riskier. Okay, so by the time you're on growth capital, those guys will be slightly lower. But ideally, see, the 25% is the bare minimum that anybody in the private market will ask for you. Okay, that should be your taker.
Your FD rate is 10%, double. That's the expectation, and there are a lot of people who will be happy with 5% return. You look at the bond yield in the US, right? People are happy with it, but you have the backing of the US government, right? So it is all, I think, a matter of risk and expected risk and return. Yeah.
This is, look, assume for a minute that I invested in your business. It's a, I don't know, it's a restaurant, it's making money, it's better than serves better biryani than Paragon, etc., etc. So you have no investment, you whatever. But I wouldn't want to inherit that to my son, seeing that kadayil namakku oru share undu ella maasam kittum. That may stop after a while, and he may want to have money in his, where he can from a bank. Look, other than you, as the entrepreneur or immediate close family, nobody wants to be tied at the hip for a life. I mean, I haven't seen it. I don't think anybody in their right mind would do that.
That's just getting a co-founder who's a financial co-founder. Yeah, then get somebody like that. He's not an investor.
In general, don't collect money from too many people, and then for whatever reason, you finally at the end of the day, you also want to sleep peacefully at night. I think there are some questions. Right?
Yeah, hi.
We have time.
I'm Shijit Raghunathan and here as part of Xamarin projects.
Sorry, I didn't get you.
My name is Shijit Raghunathan. I'm here as part of Xamarin projects, one of the director there.
Okay.
You had this thing about the moment you take your first VC, right? Or investment from somebody else, the direction is different. I agree to that. But let's say you have a company that is making out profit and it's okay, right? And you have an expansion plan. But there is a fund requirement. I am hesitant to take a fund because the fund, whoever is going to give me a fund will be focused on the returns, right?
Yes.
Whereas I have a business philosophy. So when it grows and I see the market is, I have an ideology. But then to expand, how do I get the fund, right?
Ideology doesn't include giving returns to the investor. For God's sake, don't take money from external people. And then you are asking them to finance your passion in life. His passion in life may be something else. So don't make that mistake. It's going to create problems for both you and the investor. And if you're already making money, please try and see if you can get debt. I told you, debt is far, far cheaper. I mean, people don't realize that because on the face of it, investors, you are not committing any dividend, etc., etc., but you are committing a portion of whatever wealth you have built. And look, if you run, there are lots of businesses which are run without profit motive. I personally have invested because I may like their motive. I mean, otherwise, then be clear about what your motives are, A, B, C, D, E. Find an investor who buys that vision and say that, look, and Kashidam, I mean, let's try our hand. We may or may not make money. It's okay. I won't come and eat your brain.
And if the money you're making is not sufficient to finance the growth that you're looking for, okay, then it's probably not worth growing. Take it from me. Because it might not hit you today, but it will make you do things 2 years later or 3 years later, which you probably, as you said, goes against your philosophy. Then sit, and you're in India, okay? India is a growing market, will probably grow for the next 25 years. There will be no lack of opportunities, okay? This is not the US, this is not Japan where you're growing at 2%, 3%. US is probably still better, like some parts of Europe maybe. So don't go down the path of saying, oh, if not this opportunity, I'm not going to grow. No, that's a myth, okay? There will be more growth options. So I'm saying don't give away your freedom or very highly valued capital that you're building in your own firm for short term. If what you're chasing is to be in the newspapers, please go ahead, raise $100 million, okay? There are better ways of getting into the newspapers, that's a different question. But if that is what you seek, please go down. But then you know what you're getting. It's a very, if your growth cannot be financed by what you're earning, don't grow. It's the reverse. Grow only to the extent of what you can finance.
Thank you.
All right, thank you. My name is Sharon. I'm the co-founder of Meanwhile Care, a health tech startup based out of Kochi. So I want to get back to something that Jacob said. It's like debt versus equity, right? You said preferred debt. And being a startup founder, where I want the early stages of my company to be entirely in the control, the direction of the company entirely to be in the control of my board. I know like debt sounds attractive. But then I also want to do justice to the company by providing with speed, right? And with for the incredible speed that current competitive environment demands, we need a good amount of capital initially, and we cannot promise the money back in the early stages. So when you say debt versus equity, is there a stage where in one phase, maybe like from the early stage to maybe Series A, where you prefer the equity stages, and then after that, you prefer the debt stages for growing? And
look, early stages you won't get debt. While I said debt is cheaper, nobody will give you debt because business does not have established cash flow unless you are willing to collateralize your personal asset like your home or some other land. You just won't get debt. So debt is, practically speaking, not an option.
Mostly because I think Startup Mission and everyone, they have programs where they offer it.
That will okay. If what you're looking for is 5 lakhs, 10 lakhs, there are government programs today which will give you 50. If that 50 is going to make you a 10 crore company, please take it. But beyond that, I don't see, India is not a market where you get this. Right. In the interim, we saw some animals like venture debt, but venture debt in India is monkey see, monkey do. Right. If you have a good VC fund, they will give you venture debt. If you don't have it, you're not getting venture debt. Okay, right. That's the reality of the market.
All right.
Okay? So,
I think short answer is don't take debt to fund your losses. So initially you're going to go it's a risky, you're taking a bet, right? Saying, okay, this philosophy, I'll try to get, most likely that is loss. Or, R&D, which is very intangible, right? That should ideally be funded by equity. I think, so for example, KSIDC has, KSP has huge deals. So I know companies that have received 25 lakhs, 50 lakhs even. There are companies that have received CSR grants of 1 crore, 2 crore, right? So if you have, if you match that criteria, do your research.
Right.
Typically, the contact here will be, I think, KSUM has publishes, I think, every year they publish a list of all document.
I do have it, yes.
Which says these are the schemes available. Please look through those schemes. You will find practically zero cost money, grants, debt, all that.
Right.
You will find. Also, KSIDC and I think even so this is the KSUM is the Kerala government, right? There are central government schemes.
TIDB, TIAF, the
Yeah,
bunch of these
seeding-
things. But you know,
seed
remember
fund.
the upper limit for this is about 1 crore. Is that a safe number? Max.
Right.
You'll get 10 lakhs, 25 lakhs, maybe go to 50. You get state plus central put together. You'll get to about 1 crore max. If you're lucky, they love your product. They think it's earth shattering. You know, it's doing lots of things in life. You'll get there. That's the capital.
But
If 1
that's
crore,
good enough,
Huh?
you know.
No, if that is good enough, please go down that path.
No, I was actually arguing that isn't equity the preferential choice for early stage startups?
You should, if you tick all the, yeah, it's the only.
Only option. That,
All right.
but
Then
probably
we're just
people-
saying tick all the other things
All
which
right.
we've been talking, right?
Well, one final question.
If you can get it free, nothing. Free is better than.
Absolutely. One final question to align with the theme of this is the exit strategy. Why should founders exit? I just calling back to a few examples that Deepak shared. Going back to like how GE goes on acquiring a lot of companies. I know a lot of companies personally, and that go over acquiring a lot of companies. So as a startup founder, you spend a lot of your years building a company, building an identity around it. And then, is there any way we can have a say in, especially when you're talking about clauses, where investors have clauses, where we can have clauses when we sell a company or get it to exit, where you can't do this with the company, you can't do that, because it is tied with your identity. If you have spent like
for a
7.
limited period of time when you are in control of that business. So for example, Jacob sold his company, right?
Right.
So he's there for the last, let's say he has a commitment to spend 5 years, right? It's called a retainer period, right? During the retainer period, you might have some control. But
Okay.
after you have ceded control,
Right.
it's somebody else's baby, right? So they should decide.
Not to call it baby, you said it.
No, I consciously, I mean, I got acquired, I had a investment banking business which we sold to a large company. I got some shares, I have a board seat, I have not joined the board. I don't want any control. I am conscious, I am aware that, look, I have sold my business. Don't
Alright.
carry this huge baggage on your shoulder. The less baggage you have, the more you travel, the more you see. Life is about travel.
And remember, once you have 10, 20, 30, 50 crores in your bank account, you'll have better ideas. There is life after an exit. Okay? So get there.
Enjoy life.
I'll take that advice.
Huh? And you are much younger, and I am. I was with a friend in the
Sorry,
morning.
I have to interrupt you on this. Once you have 30 crores, please make angel investments.
I'll think of that.
And you have age on your side when you grow older like me. The kind of things you can do with money only comes down with each passing year. So, as he said, do something with your money, then run after your ex-baby.
We have this conversation, as bankers, we go to invest, companies. They say, oh, I get 500 crores, what will I do? Baba, get 500 crores. Now, business ideas will come. And maybe you worked hard, your kids might want to just enjoy with the 500 crores. So why are you making them slog with what you built as a company? Move on. Chill. It's see, the role models, if you're thinking of exit, need to be the Western role models of people in Tech Valley. You're by making companies, selling them, moving on to the next thing. Maybe your third venture will be a failure. You'll wipe out $10 million of hard earned. If that is fun and that is what excites you, do go. If you want to build a mammoth company, then get to 600 crores, do an IPO, be 60%. Can't sell it, but you'll have social this thing. In newspapers will say, oh, because your 10% of the stock price went up, you're now a millionaire. Next day, Mahuma Maitra will scream in this thing and billions get wiped out. That's a different journey. And there's no right or wrong in this. It's what gives you joy.
Sorry, we are running out of time. Last 2 or 3 questions if somebody has. Yeah, please.
Hi, so I'm Firoz. So I joined my brother and I started a company called Trilak back in 2018. We are now valued at $5 million.
At how much?
$5 million, completely bootstrapped. But it is a travel marketplace for helping travelers discover travel experiences online. right? But COVID was a nightmare for us. Growing 215%, going down all the way down during the COVID was a nightmare. But after COVID, we were actually thinking to take external investment or continue to the way that we have been doing now. So I think this section was a eye opener. I just want to ask, you have been saying about convertible credit notes, right? And so if not equity investment from external investors, what do you think for a bootstrap startup valued at $5 million should focus on? Is it?
I don't know.
Yeah. So no, I mean we basically did a valuation internally based on the business that we have been doing.
The only valuation at Count, you can get any valuation report from anybody, including the Big Four. I do that for a living. I did that for a living for 30 years. Only valuation that is really relevant is the valuation which an investor like Kamath would write a check for you. I think you knew a specific thing, maybe happy to take this offline. We need to understand the business a little bit more, but if life is going well without an investor, please don't take a monkey like us on your back.
Yeah, like you said,
we are not angels, we are more devil.
Monday morning.
It's a bit like, God's own country and devil's own people. So we are the second part.
All right. Yeah. Maybe
happy to take that question offline, Feroz.
Sure.
One last question. So,
Any last question?
I'm working on a product called WageWise. It's like employee management software, but for companies in the medium sector, like looking to expand a bit more, they're not organized yet. So my question is, as Kamath sir mentioned about SHAs, there are certain things in SHAs that you have to keep an eye on. So similar to that, while exiting too, you'll have a contract, right? So like sir mentioned, there are clauses about retaining in that company for a while. So is there any other clause you think we should keep an eye on in case if we're looking at,
specific to your industry, to your particular business? So it's the motherhood statements doesn't really make sense. It's a very specific thing. I solve my business. I have a 5-year contract with my purchaser.
You probably will see a non-compete and a non-solicit as a standard clause. But, we should probably, as a next have a masterclass on just the documents maybe.
In a year, between the KSUM and probably TiE events, there will definitely be a masterclass on this specific item. Please to come and attend. I would probably look at a section called reps and warranties, representations and warranties. Just be watchful of that. So don't commit anything. These are basically representations saying, okay, my company is good. So define those carefully. I think that's probably that's probably where the hidden catch is.
And don't sign anything you don't understand. People may use lot of jargon. It is, including valuation, is 7th standard arithmetic. There is nothing nuclear physics about any of these things. If you put your mind, and nowadays Google is there, you can treasure trove of information. Don't sign anything you don't understand. Just ask more questions. I think we have run out of time. Thanks a lot for coming here and being with us. And thanks to my panelists, Deepak and Kamath, for having a lively conversation. And thanks everybody.